All right, so today I wanted to make another video on a stock that I've never talked about before. This is S&P Global. SPGI is the ticker symbol. First things first, if you get value out of the video, please like, subscribe, comment, check out those links below. So getting right into it here, $145 billion company. They pay a dividend yield, or dividend yield is 0.86%, 3.83 free cash flow yield, 2.65 earnings yield. If we look at their description, engages in the provision of transparent and independent ratings, benchmarks, analytics, and data to the capital and commodity markets worldwide. So very similar to Moody's, which is a company that I talked about recently. And the first question people probably would ask is, okay, well, which one do you prefer? And I did look into it, and I do think Moody's is a little bit better, but they're both good companies, and they're both companies that I would buy if they were the right price. So let's get right into it here. If we look at their profitability, very, very good. 40% operating margin, 27% net margin, 39% free cash flow margin. Management doing a pretty good job. Return on invested capital and return on equity, I wish those were a little bit better, but they're still okay. They're growing very well. Current ratio is below 1, which definitely makes me a little bit concerned, but they are buying back shares, so I do like that. The current ratio is not something that would cause me to not buy it, but it's definitely something that I am a little bit concerned about. The dividend I'll get into a little bit later. Earnings are projected to be up 44% next year. Revenue about 10%. Analysts are extremely bullish on this company. They are below their historical average PE, price to free cash flow, and price to sales, but I still think it's expensive where it's at right now, which I will get into in a little bit. The dividend, if we look at the dividend here, 0.86%, like I said, the payout ratio is 32%. They're growing that dividend about 7 to 8% over the last 3 to 5 years. So that's what I like that number. It's not, I wish it was a little bit higher, but consistent growth is what I'm looking for. So I am happy with that. Getting into the financials here, this is obviously the most important. If we look at their income statement, revenue is growing literally every single quarter. Basically, market down, it's going up every single quarter. So I very much like that. If we look at shares outstanding, also are going down every single quarter, starting back in second quarter of 2022. So they did dilute a little bit there, but they did reverse that trend, which obviously I want to see. If they were diluting consistently, I definitely would not buy them. So I definitely would want to make sure that they continue to, at the very least, not issue new shares. If we look at earnings, earnings is basically at an all-time high. It was slightly higher back in that first quarter of 2022, but it is trending up again, and it probably will surpass that very soon. So getting into the metrics here, like I mentioned, the profitability metrics are very, very good on this company. Very good operating margin. It's not even at an all-time high, but it's still very good. Same goes for net margin. Also still not at an all-time high, but very, very good. Free cash flow margin is, again, not at an all-time high, but 39% is very, very good. Not the least bit concerning there. Return on equity is kind of all over the board for this company. Same for return on invested capital. So I actually was wrong there, because these numbers are pointing to a no wait. That is not actually recent. If we look at the current return on equity and return on invested capital, they are lower, right? They are lower because they were actually skewed by these numbers. They were like over 100% for a while there. I don't know exactly what was going on there. Obviously there was some accounting gimmicks, for lack of a better way of putting it, but if you go back to, let's say, 2023, that number is trending up basically ever since going into 2022. So it must have been related to the shares or something there. Honestly, that's something that I would have to dig deeper on. I'm not actually sure why that was like that. But if you go back to basically that second quarter of 2023, they've been trending up ever since then, which I am happy with. Same goes for return on invested capital. That number is actually consistently going up, which return on invested capital usually is a better metric than return on equity anyway, because return on invested capital doesn't include debt. So that's something I do like. I mean, over 10% return on invested capital, that's a respectable number. And then if we look at free cash flow per share, this is, I believe it's at an all-time high. Yes, that number's trending up quite nicely. So I do like that. That's very good to see. And then I did mention revenue per share earlier. Revenue per share just consistently going higher and higher. It looks like they did go down a little bit back in 2022, but that probably was because of that share issuance. So I very much like that. Now, if we go back long term here, I'm actually going back to about 2010 on this number. They've grown revenue about 6% per year. Earnings about 11% per year. Shares outstanding are about flat. Their net margin, their operating margin have gone up. Their PE has gone up quite significantly just based on the compounded annual growth rate. The average is about 32. They're currently at, I think, around 37. So let's get into the valuation here just to try to value where I think this company should be trading. So I'm assuming they grow earnings at 10% per year. They don't dilute. They keep the shares this exactly where they're at. They grow the dividend at 7% per year, and they trade for a 30 PE. Fair value is about 13% below where it currently is. I think that's a pretty fair number. If they can grow earnings at 11% per year, that implies they're about 9% undervalued. If they can grow at 12% per year, that implies they're about 5% undervalued. That's about as aggressive as I would want to go with my price target. But I mean, let's say they grow at 10% per year, but they're worth a 25 PE. That implies that they're actually significantly overvalued. So you have to be careful here, because a company like this needs to maintain their margins for you to buy them. If their margins come down, they're actually quite overvalued, but I do think they're going to be able to maintain them. But you have to keep that in mind. Companies like this are companies that I definitely want to own, but I don't want them to be large positions. I want them to be 1 or 2%, because I do think they have a lot of upside, but you have to be careful. You have to be careful with companies that trade at high premiums. Basically, any company that's trading over a 20 to 25 PE, you want to be careful, because they're trading at a multiple that comes with added risk, which means you have to be careful, because with more risk, potentially you could get more downside. Now, if you're careful and if you do things right, well, that implies you're going to get more upside. But again, you do have to be careful. So anyway, that is SPGI. Like I mentioned at the start of the video, please like, comment, subscribe, and check out those links below.